Welcome back to the Deep Dive. We're here to cut through the noise, get you those critical insights from the digital world.
Good to be here.
Now, for many of you listening, especially if you follow crypto, stablecoins aren't exactly a new idea.
Pretty common term now.
But what makes them really fascinating and, let's be honest, incredibly profitable for the companies issuing them is this sort of paradox.
Right. They're built for stability, but the businesses behind them. Explosive growth. It seems counterintuitive.
Totally. And just to give you a sense of the scale here, get this, in 2024 alone, stablecoin transactions hit, wait for it, $27.6 trillion.
Wow.
Yeah. That's actually more than Visa and Mastercard's combined volume.
That really puts it in perspective. And market cap is up too, right?
Way up. Over 39% just since the start of the year. So the big question we're tackling today is, what are these stable tokens really? And how on earth are companies making billions from something designed to, well, stay stable?
It's a great question. We're going to unpack that. It's a crucial part of the digital finance world, often misunderstood, but it's seriously changing how money moves.
Okay, let's start with the basics then. At their core, what is a stablecoin?
So think of them as crypto tokens. They live on a blockchain, right? On-chain. But unlike Bitcoin or something volatile, they're designed to keep a steady value.
Usually pegged to something familiar, like the US dollar.
Exactly. Most often pegged one-to-one to the US dollar. So one token aims to always be worth $1. It's like a digital dollar claim.
Which is totally different from, say, Bitcoin or Ether, which can swing wildly in price.
Precisely. Those don't have that direct backing or, that stable peg. Stablecoins are meant to be the bridge. They connect the volatile crypto world to the traditional finance system.
So you get the benefits of crypto, the speed, the global reach, without the crazy price swings.
That's the idea. High liquidity, easy global transfers, and yeah, that promise of a stable value within the crypto ecosystem, that's the appeal.
And who's issuing these? Is it banks, governments?
Mostly private companies. The two biggest players you hear about are Tether, that's USDT, and Circle, which issues USDC. They dominate the market.
Okay. How does it work? Like, how do they actually create and back these tokens?
The basic mechanism is pretty straightforward, actually. A customer, maybe a big trading firm, deposits fiat currency, let's say US dollars with the issuer, like Circle.
Okay.
Circle then creates or mints an equivalent amount of USDC stablecoins and gives them to the customer. So deposit $1 million, get 1 million USDC.
So where does that $1 million go? Does Circle just keep it in a checking account?
No, not just sitting there. That's the key. They take that fiat and invest it, but they invest it in very safe, very liquid assets.
Like what kind of assets?
Think short-term US Treasury bonds, T-bills, basically. Super safe. Or sometimes high-quality bank deposits, things they can sell quickly if needed.
So investing the customer's money backs the stablecoin, and it ensures they can give the dollars back if someone wants to redeem their USDC.
Exactly. It serves both purposes. It creates a liability for the issuer they owe that dollar back, but it also guarantees that one-to-one convertibility. It's designed for safety and quick access.
Got it. Now, you mentioned stable, but I guess it's not the one-size-fits-all situation. There are different types.
Yeah, definitely not all the same. There are different models, and they have, different ways of staying stable, different risks, and crucially, different ways the issuers make money.
Okay, let's break those down. What's the most common type?
That would be the fiat-backed ones, the centralized kind we've mostly been talking about.
Like Tether's USDT and Circle's USDC.
Correct. It's simple. Conceptually, you give them 100 real US dollars. They give you 100 digital tokens on a blockchain that represent those dollars. You can, in theory, always swap them back one for one.
And they hold the actual dollars or equivalents like those T-bills in reserve.
Yes, exactly. In bank accounts or invested in those safe liquid assets. And because it is centralized, the issuer, like Circle or Tether, actually has the power to freeze funds or block transactions if they suspect something illicit is going on.
Ah, okay. That's a key difference from maybe more decentralized options.
For sure. Which brings us to the next type, crypto-backed stablecoins. These take a more decentralized path.
So instead of dollars in the bank, they use other cryptos as collateral.
Right. The big example here is DAI from maker DAO. It aims for a $1 peg, but it's backed by other cryptocurrencies locked in smart contracts.
How does that work? If crypto prices are volatile, how does DAI stay stable?
Through over-collateralization, this is really important. To create, say, 100 DAI, which is worth about $100, you have to lock up more than $100 worth of another crypto, like Ethereum.
How much more?
often 150% or even higher. So
Yeah.
you might need to lock $150 or $200 worth of ETH to borrow 100 DAI. Many people go even higher, like 200, 300%, just to lower the risk of getting liquidated.
Liquidated. What happens then?
If the value of your locked collateral, your ETH, drops too much, say, ETH crashes the system, automatically sells off your collateral to pay back the DAI loan and keep DAI itself stable at $1.
Okay, so the pros are decentralization, not relying on banks.
Yeah.
You can leverage your crypto without selling it. But the cons are that volatility risk and getting liquidated.
Exactly. Plus, sometimes the legal status can be a bit murkier compared to the directly fiat-backed ones.
Right. And then there's the third type, the one that sounds, well, a bit scary after what happened a few years ago, algorithmic stablecoins.
Ah, yes, the controversial one. These are different because they don't have any direct collateral backing them. No dollars, no crypto held in reserve.
So how do they possibly maintain a peg, like $1?
In theory, it's all done through algorithms and manipulating supply and demand. If the price goes above $1, the algorithm mints more tokens to increase supply, hoping to push the price back down.
And if it drops below $1?
The algorithm tries to buy back or burn tokens to reduce supply, trying to push the price back up.
But what's actually supporting the value? It sounds like it's built on air.
That's the criticism, and it's largely true. It relies entirely on market confidence and arbitrageurs believing the system will work. There's no actual asset backing it.
And we saw how that can go wrong. The TerraUSD example, UST, that was algorithmic, right?
Oh, poster child for the risks, yes.
Uh-huh.
UST was linked to its sister token, LNA. It got huge, over $18 billion market cap in 2022. But it relied on this mechanism where you could always burn $1 worth of UST to mint $1 worth of LNA and vice versa.
What went wrong?
Confidence just evaporated. A sell-off started and the algorithm couldn't keep up. As people rushed to burn UST for LNA, it minted massive amounts of LNA, crashing its price, which made people even less confident in UST. It was a death spiral.
Wiped out billions, right?
Tens of billions. The whole Lunane UST ecosystem collapsed. It was one of the biggest shocks in crypto history.
So algorithmic stablecoins.
Yeah.
Are they still a thing?
Theoretically, they offer this idea of a purely on-chain, collateral-free stablecoin. But practically, it's proven to be incredibly risky. After Terra, regulators everywhere are clamping down hard or just outright banning them.
Okay, that makes sense. So we've got fiat-backed, crypto-backed, and the risky algorithmic ones. Now let's get back to that central paradox. How do the companies behind the big ones, the fiat-backed ones like Tether and Circle, make so much money from stability?
Right, this is the core of it.
Mm-hmm.
They aim for a stable $1 value for the token, but the issuers themselves are raking in profits. You mentioned Tether's 2024 profit over $13 billion, just staggering.
How?
The main engine, the biggest driver by far, is the interest and income they earn from investing those massive reserves.
Ah, the money people deposit to get the stablecoins in the first place.
Exactly. Remember we said they don't just let that fiat sit there. They invest it mostly in those super safe, short-term US Treasury bonds, T-bills, maybe some bank deposits, other highly liquid stuff. And here's where something like the Federal Reserve's policy becomes really important. In 2024, 2025, when the Fed kept interest rates relatively high, around 5%, these companies made a fortune.
Because they're earning that 5% interest on billions or tens of billions of dollars in reserves.
Precisely. Scale is everything here. Let's say Circle has $60 billion in reserves backing USDC, even if they only earn a conservative 4% average annual yield on that.
That's, let me think, $2.4 billion in profit.
Exactly. $2.4 billion with very, very little risk because they're holding ultra-safe assets.
Well, wait, if I put my money in a regular bank savings account, I might get some interest, right? Even if it's small. Do stablecoin holders get any of that interest?
Generally, no, or very, very little. That's the key difference in the core of their business model. You, the user, deposit fiat. You get the stablecoin, which offers utility like payments or trading.
And the issuer keeps basically all the interest earned on the underlying fiat.
That's pretty much it. Think about it. Traditional banks have lots of costs. Branches, regulatory capital requirements, deposit insurance. They have to pay interest to compete for deposits. They face loan losses. Stablecoin issuers historically had much lower overhead, simpler 1.1 reserve models, and didn't act like banks lending money out.
So they capture almost the entire yield from those T-bills. It's like they're running a giant money market fund, but keeping all the returns.
That's a pretty good analogy. And it creates this powerful incentive. The more stablecoins they issue, the bigger their reserves, the more interest they earn. Growth directly equals more profit.
Wow. Okay, so that's the primary driver.
Yeah.
Interest on reserves. Are there other ways they make money? Are they investing in riskier stuff too?
They are diversifying, yes. Companies like Tether, for example, have built up significant investment portfolios beyond the stablecoin reserves. But, and this is crucial, they state these investments are made from their own accumulated business profits, not from the funds backing USDT.
What kind of things are they investing their profits in?
It's pretty diverse. As of early 2025, Tether reportedly held over 100,000 Bitcoin.
Whoa.
Yeah, and about 50 tons of gold, too, kind of value hedges. But they're also pushing into venture capital territory, investing in AI, neurotech, DeFi projects, payment systems, other tech startups. Tether Investments apparently manages stakes in over 120 companies.
That's quite an operation.
And what's really wild is the efficiency. Tether reportedly does all this, generating that $13 billion plus annual profit with only around 150 employees.
150 people. That profit per employee is astronomical, almost unheard of.
It really highlights how different the model is from traditional finance or even many tech firms.
Okay, so interest on reserves is huge. Profits from other investments are growing. Is there anything else?
There's a third stream, less significant overall perhaps, but still notable. Redeem fees, mainly for institutional clients.
So not for regular folks trading USDT on an exchange.
No, typically not. This is for the big players, investment funds, crypto exchanges, fintech companies who want to convert large amounts of stablecoins back into actual fiat currency directly with the issuer.
Is there a minimum amount for that?
Usually, yes. For Tether, it's often cited as $100,000 minimum, and then they charge a fee for that redemption service.
What kind of fee?
It can be a fixed amount or a small percentage, maybe around 0.1%, but it varies depending on the client and the contract. It's not like a blockchain network fee. It's a service fee charged by Tether or Circle.
And what's that fee for? Just pure profit?
It covers their operational cost for handling these large fiat transactions, banking relationships, legal work, and really importantly, the costs of KYC compliance.
Know your customer and anti-money laundering.
Right. These checks are vital for them to manage risk and prevent illicit use, so the fees help cover that infrastructure and control the flow of funds.
Okay, so massive profits from interest, growing investments, and some fees, but it can't all be smooth sailing, right? What are the big challenges or changes on the horizon?
Number one, without a doubt, is increasing regulatory scrutiny all around the world.
Lawmakers are finally catching up.
Definitely. Stablecoins are now a major focus. Regulators are demanding stricter rules about the reserves, what assets are allowed, how transparent they have to be, plus stronger compliance overall.
Any specific examples?
Europe's MiCA regulation is a big one. It creates specific categories like e-money tokens and asset reference tokens. It mandates proper 1.1 reserves of highly liquid assets, requires regular audits, puts them under the European Banking Authority.
Okay.
And here's a really interesting part. MiCA actually prohibits issuers from paying interest directly to stablecoin holders.
Wow, so that kills the idea of interest-bearing stablecoins in Europe.
Effectively, yes. It locks in that model where the issuer keeps the interest from the reserves.
What about the U.S.?
There's proposed legislation, like the Genius Act. It aims to create a federal framework. The idea is to limit who can issue stablecoins to highly regulated entities, think subsidiaries of banks or institutions approved by the OCC, the bank regulator.
And what would they require?
Similar things. Guaranteed 1.1 reserves, clear reporting on risks, public disclosures, and importantly, rules to protect holders if the issuer goes bankrupt.
So this regulation, is it good or bad for the industry? It sounds like more costs, more rules.
It's definitely a double-edged sword.
Ugh.
Yes, compliance costs go up, operations get more complex, maybe less flexibility for the issuers.
But the flip side?
The flip side is clarity and legitimacy. Clearer rules could allow stablecoins to integrate much more deeply into the traditional financial system. Think mainstream e-commerce, faster cross-border payments, becoming part of the core payment infrastructure.
So it could unlock even bigger opportunities despite the costs.
That's the potential trade-off. Will the benefits of mainstream acceptance outweigh the burden of tighter regulation? That's the big question for Tether, Circle, and others.
Interesting. What else is changing?
Another big trend is national stablecoin issuance. Countries are starting to wake up to the fact that USD-pegged stablecoins, like USDT and USDC, are getting deeply embedded in their own financial systems.
And they don't like relying so much on the US dollar digitally.
Partly that. And also, think about it. When Tether and Circle buy billions in UST bills with their reserves, they're effectively helping finance the U.S. government's debt. It reinforces the dollar's global dominance.
Ah, Hadn't thought of that angle. So other countries want their own digital versions.
Exactly. They're promoting stablecoins pegged to their own currencies. Japan passed a law in 2023, and now you have JPYC working on a licensed yen-backed stablecoin backed by yen deposits and Japanese government bonds.
Okay.
Hong Kong, too. Their stablecoin ordinance takes effect August 1st, 2025. It requires licenses for fiat-backed stablecoins and specifically paves the way for a legal Hong Kong dollar stablecoin.
So we could see a wave of localization. EUR stablecoins, GBP stablecoins, all officially sanctioned.
It seems likely. It's a way for countries to maintain some monetary sovereignty in the digital age.
And one last factor we touched on, that reliance on interest rates.
Yeah, this is a fundamental point about their current business model, since so much profit comes from investing reserves in short-term bonds.
Their fate is tied to what the central banks do, especially the Fed.
Absolutely. High rates, like in 2023, 2024, meant record profits. But if rates fall significantly,
Profits would drop.
dramatically, some estimates suggest that just a 1% drop in the yield they earn on reserves could cost the industry over $1.5 billion a year in revenue.
So their profitability is actually quite sensitive to the wider economy.
Very much so. The stability of the token doesn't mean stability of the issuer's profits.
Fascinating. So tying this all together, it really feels like these stablecoin issuers have become sort of like digital intermediary banks for the Web3 world.
That's a good way to put it. They provide that essential liquidity, the bridge to fiat, the stability needed for trading and payments within the crypto ecosystem, but with a very different and often, as we've seen, much more profitable model than traditional banks.
Looking ahead then, what's the summary? Challenges and opportunities.
Challenges. Definitely potential pressure on their profit margins, maybe from traditional banks entering the space, maybe from new types of stablecoins, and certainly from those rising compliance costs due to regulation.
But the opportunity.
The silver lining is huge. That clearer legal framework, if it comes together globally, could bring massive legitimacy. It could unlock mainstream adoption on a scale we haven't seen yet.
Feels like we're really at a turning point for how digital money works.
I think so. The integration is happening, and it's changing how value moves around the world.
So here's something for you, our listeners, to chew on. Considering these immense profits generated just from holding stable reserves and this global push for regulation, what role do you think stablecoins will ultimately play? How might they reshape finance and maybe even how you handle money day to day?
Lots to think about there.
Definitely. Thanks for joining us on this deep dive.